Let's review what we learned in Unit 3 with straight line depreciation. So that's a method where we allocate the exact same amount of depreciation every reporting period. So we used the formula, which was the expense equals the cost less the residual value divided by the useful life. And let's say that calculated out at $10,000. That meant the expense every year was $10,000. It won't change for the life of the asset. So I guess what we're assuming here is that if we're going to charge the same amount of depreciation every year, the asset's going to be used the exact same amount, and therefore it's probably going to earn the exact same amount of revenue every year. Now, assets that might be true for would be things like shop fittings, or maybe display equipment, furniture, desks, that sort of stuff. They don't really get any less effective in generating revenue as they get older. The display equipment's going to be just as effective in year 10 as it is in year 1. Shop fittings and coat hangers and so on are going to be just as effective in year 5 as they are the day you bought them. They don't change, so it kind of makes sense to charge the same amount of depreciation every year for those things. Straight line depreciation, and why we're charging it for things like shop fittings, display equipment, furniture and so on, is because it's all about the theory. The theory says reporting period, match revenues with the expenses for that period. Well, if a piece of shop fitting or display equipment is going to be used a certain amount or the same amount every year, it makes sense to charge the same amount of depreciation every year. So we charge the exact same every period. Likewise, relevance says we want an accurate profit under accrual accounting to make better decisions. And if a chair that's in the office is going to help generate the same amount of profit every year, it's going to be used the exact same amount, more or less, we should charge the same amount of depreciation at a consistent rate every year.